So how much money should you save versus how much money should you invest is a question that's been on my mind since I was like 9 years old because my parents were immigrants and they didn't teach me about money. And I don't think it's normal for 9-year-olds to wonder that, but check this out. How wide do you want your lens to be? Yes, but check this out. When I was 9, I'd also learned this one card trick called the Cobra Cut, and it looks like this, because it looks like a danger noodle. It's a snake with the mouth and the prey on top, and then it just strikes at its prey. And in 2004, I thought that was the coolest thing in the world. I still think that, but this was back when message boards and forums were becoming a thing, and I made a username for myself called Monies Are Us because I was obsessed with money and Toys R Us. So if that doesn't prove to you that I was obsessed with money from an early age, then this continuity error will. It's the same deck. Whew, what just happened? We printed money. So if you thought that was a cringy intro to a video, well then at least it's not TikTok style. I actually really like TikTok. I would make one myself if I knew people would follow me. Would you follow me? Like, you're gonna answer me through the lens. Yes, let's just start the video. Hi, my name is Andrei Jikh. Hope you're doing well, hope you're staying safe, and I don't have a lot of credentials to show you. I've only been investing since around 2012, and I don't know the answer to everything, so this video is not going to answer all of your questions, but I've been saving money for a lot longer than that, and I was able to get to this point in my Robinhood brokerage account, earning only $50K a year for about 5 years and saving half of my income. And between good luck in the stock market and living well below my means is how I was able to get to this point. So in order to understand exactly how much money to save versus invest, you have to understand what is going on in the world today. So this one comes from fredstlouis.org. It has one of the nation's top leading economic teams that explains bond rates, stock rates, and housing rates, and everything in between. It's a free resource, so please use them. But this next chart is probably the most telling one. It's gonna seem very complicated, but I promise I'll make it easy to understand. It's what's called the velocity of money, and it measures how fast we exchange money between ourselves. And for each dollar that we print and create into the economy, exactly how much value we create in return in a given amount of time. Now, what this graph shows us right now is that we are at an all-time low for the velocity of money. And that means right now, people are not spending, they're not buying, they're not selling, they're not trading that money, which has the potential to create a deflationary economic collapse. What this means is stock prices, house prices all start to fall or deflate as more and more people want to save more money rather than spend it. So in relation to everything else, the dollar is technically climbing higher, and that's what creates the fall or the deflation. So to prevent this from happening, the Federal Reserve's like, wait. Let's keep this party going. And so in this case, they want inflation rather than deflation, which is the exact opposite. So in an inflationary economy, the savers are the losers, and it's the people that get themselves into debt by buying assets like stocks and real estate and who leverage their money who are the real winners. And if the Federal Reserve can target their 2% per year inflation rate and achieve it, which is not a guarantee, but if they can, then asset prices should rise. And that's because the same amount of dollar will be able to buy less asset because now there's just more dollars in the system. Now, unfortunately, no one knows exactly what's gonna happen, whether we're gonna see inflation and then deflation or deflation and then inflation. It's really anybody's guess. And for that reason, I'm out, is probably what you're saying to yourself. It makes people scared because they'd rather just wait and see what happens at the end of this economic cycle. But that is the second worst thing that you can do right now. Let me show you a perfect case study of why you don't want to do that. Now, this is directly from the personal finance subreddit, which I will leave a link down below. It's an amazing thread, but assume 3 different strategies from 3 different people: Sarah, Brittany, and Tiffany. They represent the 3 females that watch my videos. It's weird, my ratio is like 20% female, 80% male. Not sure why, but they each figured out that the best way to invest is to buy and hold stocks long-term without selling. What they disagree on though is when to invest and how often. Now assume they each start with $99,000, they reinvest all their dividends, they never sell their stocks, and when they're not investing, they keep their money in a high-yield savings account, giving them 3% per year. So Brittany and Tiffany like to time the market because they don't want to invest during a market bubble, and they were right. because in the last 41 years, we've had 5 market crashes. In 1987, in 1990, in 2002, in 2009, and 2020. Now, Tiffany is the worst market timer in the world. That's because she discovered our Wall Street bets and she tried to put tendies on SPY puts and it didn't work out. But she started saving her money in 1979 and she did that for 8 straight years before finally having the courage to start investing in the stock market. And when she did, in 1987, that same day, the stock market fell 33%. So she lost a lot of money and she didn't learn her lesson because she continued to try to time the stock market. She did it again in 1990, losing 19.7%. Again in 2002, losing 49%. Then again in 2009, losing 56.5%. And in 2020, this year, she saved it again only to invest right before the big 34.1% drop. Poor Tiffany, but she never sold her stocks. And after 41 years of doing this, she ended up with $773,358, which isn't bad considering that she tried to time the market and bought stocks at the 5 worst possible times in history. Now, her friend Brittany is the complete opposite of Tiffany. She is a stock market timing genius, and she predicts the market bottom 5 times in a row, which is basically impossible for anyone to do. She buys at the exact day of the stock market bottom 5 times. And after doing this for 41 years, 5 times correctly, she ends up with $1,123,573, which is a lot of money, but it's not a crazy big difference between her and Brittany, who gets it wrong 5 out of 5. It's not like she's made 5 times more money, right? It's only a 45% difference. And then we have our third friend, Sarah, who didn't invest at the market bottom or at the top. Instead, she unsubscribed from all the financial YouTube channels because she realized they're all just trying to monetize their income by remaking the same video over and over and retitling it How to Make Passive Income 2021 style. But just like everyone else, she started investing $200 a month in 1979, and she just had the auto invest feature enabled because apparently she's a time traveler and she had a smartphone back then, and she would throw all of her money into VTI or VOO, which is a broad market index fund, which also didn't exist back in 1979, so just go with me on this one, and here's what happened. After 40 years of doing this, be honest, do you think that she ended up with less money or more money than her friends? If you guessed more, and if you guessed $1.62 million, she ended up with $500,000 more than the best market timer in the world. But how could that be? You're a wizard, Harry. Now, it's because she started investing from the very get-go in 1979 rather than waiting 8 years to invest a lump sum amount of money. And she invested consistently, which over time let compound interest do the work for her. Now, for reference, we also have a fourth friend. She's a long-lost cousin twice removed, and her name is Negative Nancy, and she's always thought that the stock market was just one giant Ponzi scheme. You probably know somebody like that, and they never invest. They just save all of their money and put it in a high-yield savings account at 3% per year. And after doing this, Negative Nancy ends up, after 41 years, with $332,000, which is less than what Tiffany has, and Tiffany has made 5 out of 5 of the worst timing decisions possible. So ask yourself, do you really want to time the stock market? Are you really smarter than Brittany? Because Brittany's a genius. But we're not done yet, because that only answers how often to invest. But how much money should you save? The answer is a little bit more nuanced than you might think, because there's 2 major theories to saving money. And the first theory says that you shouldn't even think about investing until you have at least 3 to 6 months worth of an emergency fund built up to pay for life's emergency expenses. That way, if you lose your job, you could still technically be afloat, like this stupid card trick. Or if you want to pay for college, pay off high interest rate debt, anything like that, the A7S III with this 12 to 24 G Master lens, look at that. That is insanely wide. It's also the most expensive thing I ever bought. If you want to buy a house in the next 2 to 3 years, then you should definitely prioritize saving over investing. But you don't just want to save all of it and stuff it underneath the mattress. You want to scatter it across bonds, CDs, high yield savings accounts, and whatever you do, scatter your money through different banks. Because if one bank fails and you have more than $250,000, you will lose anything above the FDIC limit, which is $250,000. And if you're investing money in a brokerage account, then you want to keep no more than $500,000 in stock in any single brokerage account, up to $250,000 in cash as well. You'd be surprised how many people that I know that are wealthy that don't do this and don't even know this. So that's the first theory of saving money. The second theory says that you don't even need an emergency savings fund. Who needs that when you have liquid investments like stocks that you can sell to pay for ordinary life expenses? You should only leave maybe a couple $1,000s in your bank account, because when you need the money, you can just sell whatever you need to sell and just pay for the rest of it. Now, the people in this camp say that this is great because every single dollar is put to work and your money's not just losing value to inflation and sitting there collecting dust for no reason. The downside to doing this, and what people criticize the most, is they say that if we're in a deflationary economy, like the one we might go into pretty soon, you might end up spending more money than you actually need to. For example, if you invested $5,000 into Tesla stock and it dropped 30%, well, now it's worth $3,500. And let's say you have to pay exactly $3,500 for a hospital bill. Then you need to sell your entire Tesla position to pay for that expense. And that means you just technically paid $5,000 instead of $3,500. So that's the downside of not having an emergency fund, which is why I have one. But someone like Kevin Paffrath, who's extremely successful here on YouTube, doesn't believe in those. Now, as far as how much money you should invest, there's a really easy way to figure this out scientifically. And the way to do this is to take your annual expenses, which is how much money you spend in a year, and multiply it by 25 years, and taking that amount and investing it at 4%. So for example, if it costs $25,000 to be Andrei every year, I would take that $25K, multiply by 25 years to get $625,000. I need to take that amount and invest it at 4%, because 4% of $625,000 is $25,000, which means I will never run out of money for the rest of my life, assuming we don't keep living like 2020 every single year hereafter. But that's the mathematical way. Now, the speed with how fast I'll get there will be entirely dependent on how much I love or hate my job. Because if you love your job, then it's gonna take you a lot longer. If you hate your job, it hurts, and you're gonna have to do everything in your power to make it not hurt. So you'll get there quicker than when you love something, you have less motivation to achieve and set very difficult goals. Now, personally, I learned something this week just from making this video, which is why this week I've purchased $10,000 of a stock that's gonna give me 10% per year, which normally I would never do unless it's justified like it was in this case, and that will add an extra $1,000 to my annual income, and that's pretty cool because even though the stock market is falling, I'm still making passive income. I'm still earning cash flow without worrying about anyone else and without working for anyone else. And if you want to do the exact same thing I'm doing, then go ahead and sign up with Webull, fund your account $100, get a free stock valued up to $1,600, get your other free stock from Robinhood, follow me on Instagram, I post from time to time, you can join my free Discord group, and of course, join my Patreon, and I will see you back here on Monday and Friday, and sometimes a Wednesday. Love you, hope you're staying safe. I'll see you very soon. Bye-bye.